Good morning, everyone. Welcome to Monday. Welcome to Monday Minutes. Very interesting pocket of time. Clearly, the debt ceiling negotiations are front and center for markets in general. It is interesting, though, if you look at volatility, in equity markets versus what we're seeing in CDS for one-year Treasury paper, certainly a wide disparity in terms of what those markets are signaling. And I think there are different reasons for why that is right now. Former Fed Vice Chair Brainard out over the weekend. Now the NEC chair saying that she feels the negotiations have been constructive between staff members. That's where things will ultimately be hashed out. And personally, we do remain hopeful that we will get some sort of resolution as we get closer to that June 1st X date per se, although we don't know that is a line written in the sand. Now, with that said, think about the market right now. Think about a scenario whereas we do get past the debt ceiling negotiations, we do get some sort of resolution, we take that chip off the table. What if there is a scenario, and it's a very plausible one, although we're priced right now about 17% for another rate hike in June. What if we do get that pause in June, or perhaps another 25 basis points if the data between now and then dictates, and then a pause and a break? Clearly, we're getting closer to the end game. And what if, as we're seeing in the inflationary data, both with PPI now with three handles, we see the services ex-housing inflation, the Fed funds rate now crossing that level, those numbers coming down. If you look at overall CPI ex-housing, certainly those numbers are very constructive right now relative to where we were. PPI down from 10% down to 3%, 7 percentage points within the year of Fed tightening. What if we combine all that? What if inflation does continue to cooperate and we get some of these risk factors off the table? We do get that Fed pause in June. What does fixed income look like on the back nine? And I think the answer is potentially very constructive. So short term, markets are concerned. We have seen some primary issuance. Issuers have certainly been coming to the market in anticipation of what lies ahead over the next couple of weeks. But these markets are still open. And certainly when you look at yield levels, they still look very attractive, although Treasury rates have come down here since the March episode with regard to the regional banks. So there is a scenario, a very plausible scenario, where the back nine of 2023 looks very constructive for fixed income markets. Looking very succinctly this week, we do get a ton of housing data. The markets are going to be very honed in on that data because housing is a very big part of the economy overall and certainly a big part of the inflationary story. And we continue to get a lot of Fed speak here short term. And if you listen to that Fed speak, look, they are still concerned about the impact, the credit impact potentially of what's going on in the regional bank crisis. That remains a concern. Sufficiently restrictive is something that we haven't necessarily come to a definitive conclusion here. Chair Powell in his presser saying that we were probably close. We could be there when you consider 500 basis points of rate increases, when you consider QT, and also when you consider the potential impact of what's going on with the regional banks, although quantifying that 25, 50, maybe 75 basis points, that's really where the uncertainty comes in for the Fed here short term. They just don't know. When you listen to Fed Governor Bowman last week coming out and saying we don't necessarily know if we are sufficiently restrictive yet, but for all intents and purposes, in our weekly piece from this past Friday, we put 10 charts out there showing the progression of the economy, forward-looking indicators, not looking terribly constructive, but in our view, certainly giving the Fed room here for a pause with a wait-and-see attitude and to see how the banking issues play out, to see how the evolution of the economy plays out. But this could very well have been the last rate hike in this cycle, perhaps one more. But certainly we think the Fed is very, very close to the end game. And from there, we think it's a pause. We're not in the rate cut camp. We're very respectful of the fact historically how the Fed can pivot, and they can pivot very quickly. But we think we live in different inflationary times. We think the Fed is still trying to separate financial stability issues from monetary policy. So when we do get that pause, we do think the Fed will be inclined to hold on here as long as they possibly can. On the ground this week, like I said, there is a ton of housing data, and we will get New York Fed President Williams speaking in the middle of the week, and we also get Chair Powell later in the week as well. Wishing everyone a great week ahead, hoping that all of the moms that follow us on our LinkedIn thread had a wonderful Mother's Day. I'm Greg Faranello. I'm head of U.S. Rates for AmeriVet Securities.